Here in New York City, I'm Brad Smith alongside Madison Mills this morning. This is Yahoo Finance's flagship show, The Morning Brief.
Stock futures slipping a bit this morning, looking a little bit mixed after the S&P 500 closed in the red, despite reaching an intraday high over 5,500 in yesterday's trade. Could the so-called triple witching be to blame for the pressure that we are seeing on equities? Let's get to it with the three things that you need to know this Friday morning as you prep for the trading day. Yahoo Finance's Jennifer Schomburger, Jared Blickery, and Anjali Kemlani have more.
Shares of Nvidia extending losses this morning after falling 3.5% in Thursday's trading session. The declines wiping out $118 billion in market value for Nvidia from the prior day, ending the chipmaker's brief run as the most valuable public company. Microsoft is now back in the #1 slot, though Nvidia is still poised for a winning week.
And there's also a big test for the markets today with a $5.5 trillion triple witching. A triple witching occurs when options on individual stocks, options on indices, and on stock futures contracts, all of those expire on the same trading day. In addition, it's S&P rebalance day with the tectonic shift in Apple versus Nvidia holdings. Nvidia has been setting records for options activity, and all in all, it's expected to be the highest volume day of the year, the defining liquidity event of the summer.
Meanwhile, we're watching big moves in biotech. Shares of Sarepta Therapeutics are up triple digits pre-market after gaining a full and expanded FDA approval for its muscular dystrophy drug. And shares of Gilead Sciences are also higher after announcing its twice-yearly vaccine to prevent HIV has demonstrated 100% efficacy in late-stage trials in Africa. Meanwhile, Zealand Pharma, a Danish biofirm, is higher on early-stage positive results from its weight loss drug.
Well, our top story this morning, shares of Nvidia extending losses this morning after Thursday's trading fueled more than $118 billion of losses in market cap, pushing Nvidia's market cap back below Microsoft's. The chipmaker no longer the most valuable public company, some jousting for sure taking place for that #1 spot, as Ludacris would say. Of course, a little music reference for Friday. But anyway, all things considered, it's more than just Nvidia that you're going to see. You've got individual stocks, indexes, ETFs, contracts, weekly contracts, and monthly options contracts set to expire on Friday. So this, the famed triple witching, the premier event of the summer, I think Jared Blickery just called it.
I know, the highest liquidity that we're going to see of the summer after the longest day of the summer. You can see on your screen right here the explanation, what happens with expirations today. You're looking at stock options, stock index futures, and stock index options, all expiring today. Now, this is interesting to look at when we think about the downward pressure that we saw in Nvidia yesterday heading into triple witching. Are the two related? And some reports and notes this morning saying yes. And that is because you do tend to see a little bit of an opportunity to sell off in some of the biggest players in the stock market heading into a triple witching day. But interestingly, a study about some of the kind of uglier reversals that we've seen historically heading into triple witching day does indicate that those high flying names do tend to be moving to the upside in a pretty big way a couple of months later after we get through the next 24-hour period. So it's interesting. You can't really separate the individual stock price action that we're seeing from that broader triple witching picture. And I wonder if that is why Nvidia has lost its #1 spot in the stock exchange versus any kind of idiosyncratic reason.
Yeah, and with a volatility event or a volume event, which can also prove and transition into a volatility-like event, I'm looking at some of the options AI data that's actually looking out even into next week and trying to predict that expected move post triple witching for Nvidia and as well a bunch of other names and indexes in the market. And it looks like there's an expected move of about 7.2% in either direction post triple witching for Nvidia by this time next week, June 28th. So that's going to be interesting to track because, of course, that will mean that we'll also be rounding out the second quarter by that juncture as well and staring down the third quarter. My goodness, third quarter of 2024 begins in just 10 days time here.
Right, we're almost ready for earnings season to restart again. It hasn't even finished.
Bring it on. Why not?
It's always earnings season. It's always, except for like 2 tiny weeks where we have nothing to talk about and we get to just pitch whatever ideas we want. Having said that, what we do want to talk about, of course, Nvidia. Those shares still under pressure, clawing back some of the downside pressure that we've seen. That stock looking like it's down about 2.5% as we head into the market open in about 30 minutes time. More experts comparing this recent AI craze to the dot-com bubble of the early 2000s. Joining us now to discuss, we have Patrick Moorhead, More Insights and Strategy founder, CEO, and chief analyst. Patrick, it is always a pleasure to speak with you. You are the foremost expert in this space, I like to say, so I appreciate you coming on this morning. There's this question out there, comparing Nvidia to a Cisco. You've been in the game long enough. Talk to me about your take on that comparison.
Yeah, so I grew up in the dot-com era. I think I was about 10 years into my career, and there are definitely parallels, right? Cisco was the driver and the builder of the infrastructure for the internet age, and there was overinvestment in this space, and NVIDIA is clearly one of the biggest builders for infrastructure of this generative AI days, and we do need to be very careful and look for what I call the precursors of something that could pull back. Now, first off, I don't see anything changing for 6 to 9 months, but we do need to look at the downstream profitability that people in the ecosystem are making or not making. These are the software companies like Adobe, Salesforce, SAP, and ServiceNow, because if those enterprises and those consumers aren't paying more for those new AI features, then this whole gravy train comes to a screeching halt, like we saw in the internet bust.
And so all these things considered, what is NVIDIA going to need to continue to prove on a sequential basis at this juncture that's going to be critical to cement this broader story that they've been able to sell the markets on?
Yeah, so growth, it's growth, and more growth. And this next generation of NVIDIA growth, the new growth, will be all about the enterprise. 80% of data for companies and businesses is still on site or on the enterprise edge. So what they're doing is they're enabling companies like HPE, Dell Technologies, and Pure Storage, and Lenovo to build that out. And this week, I actually personally attended the HPE and the Pure Storage event. This is what it was all about. This is the second layer of this data center build out.
Well, and it's interesting, in your notes to us, you explained that this is a private cloud play. How bullish of a signal is that for the chip sector in general, but specifically here for NVIDIA?
Well, it's very positive. First of all, there's a little bit of a diversification of risk, because if the only enterprise AI plays are in the public clouds, then it's pretty much winner take all. And I view this enterprise play as there's something really here. And then what you do is you have the VMwares that's owned by Broadcom, the Red Hats of the world, IBM software, and even software from HPE that will get a lift and a juice from this infrastructure build out. And here's the thing, that the enterprise data center play is more durable than, let's say, the public cloud play. It's kind of the gift that keeps on giving. So if NVIDIA and its partners can stick this landing, and enterprises can start either leveraging the benefits from enterprise SaaS companies like I talked about, or building their own, then this is going to be a 5 to 10 year run. And maybe we won't see the dot-com bust like we saw decades ago.
You mentioned all the players in the space, Patrick, and it makes me think about the competition of it all. I'm curious if you can talk about the biggest risk to NVIDIA when it comes to pricing power on its chips, and just give us some context on, the pricing of NVIDIA's chips versus some of their competitors.
Yeah, some of the earlier data center chips that NVIDIA had, they might sell for $5,000, $10,000 a piece, but now we're looking at $30,000 to $40,000 per chip, and that is astronomical. it's probably over 1,000% gross margin. But the longevity here, so you've got two levels of competition. First, you have the merchant silicon providers, the AMDs and the Intels of the world. And then you have the homegrown ones from AWS, from Azure, and from Google. And what it is a race right now is NVIDIA is trying to get a lock-in through their software. I do believe that chip makers and AMD in particular have come up and have as competitive or almost as competitive chips for training. 100% there are competitive chips for inference, but it's that software lock-in that's referred to as CUDA or NVIDIA NIMs that NVIDIA is trying to stick. So regardless of who has the better chip, you have to go with NVIDIA because of its software.
Yeah, eventually every dinner table is going to know about Compute Unified Device, whatever the A stands for, but
Right.
applications, something like that. But anyway, at the end of the day, and I'll look that up and give that back to our viewers here.
Yeah.
Architecture, that's what it is. But anyway, all these things considered, Patrick, it's been one of the most overcrowded, or de facto, as Goldman Sachs has called it, AI trades here. So as we think about NVIDIA going forward and the 10-year horizon that you were just looking at, I mean, we're right now in the ballpark of a $3 trillion market cap. What do you think it could get up to?
I don't see any reason it couldn't get up to 4 trillion. And again, a lot of this is based on expectations, because you look at PE, it's pretty astronomical, right? And if we can see some positive signs from the downstream players, because other people have to make money, not just NVIDIA, again, otherwise this comes to a screeching halt. But I don't see any reason why this couldn't get to 4 trillion if we continue to see those positive signs down in the channel, and we keep seeing positive news coming out from NVIDIA with its partners.
Patrick Moorhead, who is the More Insights and Strategy founder, CEO, and chief analyst. Patrick, great to speak with you as always.
Thank you, Brad and Maddie.
Thanks. We're seeing some big moves in biotech today. Sarepta shares surging after receiving expanded U.S. approval from the FDA for its muscular dystrophy drug. Yahoo Finance's Anjali Kamlani has all the details on this one. Hey, Anj.
That's right, Brad. Sarepta, this is one of its 4 commercial products, and getting that expanded approval from the FDA, really good news. Obviously, you can see that in the stock today. The Duchenne muscular dystrophy drug, Elevidys, was approved last June, and it was approved for with a limited label. That means that it could be used only with those who could already walk, and was sort of limited on who could be used in the younger population, but that's where they saw the most benefit. And so the FDA coming out today saying that it is approved for those 4 and older, and for those who can walk, as well as those who are wheelchair bound, is a huge move for the company. Lots of upside there, analysts are saying. And important to note that this drug already, since the approval, brought in about $334 million for the company. It already brought in $134 million in the first quarter alone, and that's about 40% of the company's revenues in that first quarter. It is a bit of a controversial drug. There are still some FDA experts who think that it has not proven its benefit in this population because it doesn't slow down the progression of the disease. But what it does do is allow mobility, and that's the key by which one top official allowed this to be approved. So that's where the controversy is, according to SAT. But we do see this as good news for Sarepta, obviously.
Anjali, I want to get your take on another story that we're watching this morning while you're with us, and this is coming from Gilead, seeing some really positive results from early trials with regards to an HIV drug. Can you talk to me about that?
That's absolutely right. It's a twice-yearly shot. It has proven 100% efficacious in women in a study, a late-stage study in Africa that's for women and adolescent girls. This adds to Gilead's sort of dominance in the HIV market, and they are known for their work with the pre-exposure prophylaxis known as PrEP. That's a huge market for them. JP analysts saying that this is why Gilead's HIV portfolio is going to be and continues to be contributing to their market cap, being the largest contributor to their market cap, currently $85 billion. And so that is something to keep an eye on when it gets approved, how much it adds, in fact, to the bottom line for the company.
100% efficacious. My goodness, Anjali. Okay. All right. The thing works. Thank you. Appreciate it. Everyone, we're just getting started on the morning brief. Coming up, Nikola announcing a 1-for-30 reverse stock split. So we're going to break down some of the trending tickers, the top trending tickers there. And Meta getting a bullish call from KeyBank. We've got the analyst behind it later on this hour. And stay tuned for our 10 a.m. hour of Catalysts, where we'll bring you a day in the life of Boston Fed President Susan Collins. You won't want to miss it. Imagine it's been a good time for her up there in Boston with that new World Championship by the NBA Finals winning Boston Celtics. Anyway, all that and much more. You're watching Yahoo Finance.
Nike getting a bullish call from Oppenheimer this morning. The firm upgrading the stock from perform to outperform, also lifting the price target from $110 up to $120, reinstating this retailer as a top mega cap pick. The analyst behind the call saying that near-term financial expectations for Nike are largely de-risked. Also, I thought the kind of quote to call out from this note is Nike is on the mend. That is a direct quote from analyst Brian Nagel writing this note saying that yes, Nike has had a slew of tough quarters, particularly given the slowdown that we've seen in consumer spending coming out of China. That's been a key kind of data point to watch when it comes to Nike's earnings. But in this note, they're saying that it's time to turn more constructive based on generally intermediate to longer term views. This price target here implying a 26% increase in this stock moving forward, Brad.
Yeah, this is the second major call that we've heard on Nike over the course of this week. We had Morgan Stanley earlier this week. They were out adjusting their outlook. They were still ultimately optimistic, but they did adjust their price target down by about $2. Morgan Stanley did. And I think for Nike, what they're going to try and communicate over the course of their results when they report for this quarter and look forward ultimately to the current quarter that we're in right now is the Olympics, quite frankly. This once every 4 years phenomenon where Nike is going to have major athletes. There are going to be a lot of major U.S. brands that have their athletes performing. I've already seen a lot of the promotional elements going on around Sydney McLaughlin, who, of course, is with New Balance. Of course, it's going to be amazing to see. I mean, golf is the one area where I think the U.S., with their own kind of annexation to apparel, has missed the mark. They've got JL that's doing, and that's a Sweden-based company, I believe, doing that. So interesting move there. But anyway, all these things considered, it's because Ralph Lauren didn't want that contract because of a Ryder Cup debacle. Anyway, all these things considered, for Nike, they're going to really be telling and selling the street on all of the advancements that they're putting forward on an innovation stance within the Olympics, and they're going to see that investors and customers will see that play out, and that it will be eventually accretive more long-term to the customer lifetime value beyond just what they've been able to do and leaning into some of the more successful brands. I'm looking at specifically Jordan Brand and how they've made that even more of a basketball, more than a retro play, even though the retro is holding up well, but also diversifying that, taking it out into, I just bought some Jordan cleats for some reason. I haven't stepped on a football
What sport
field
do you not play? Oh my God.
I mean,
this is like a roulette of sport references from Brad. I'm just trying to keep up.
Once you turn 30, you got to play them all. They're like Pokemon, the sports. You got to play them all at a certain point after you turn 30.
It's very impressive.
Try and maintain some type of physical activity. Yeah.
Well, I mean, and in your New Balance piece, we learned that you can run while doing an interview.
Well, everybody must be able to do that. You must. You simply must in this business. Yeah. I mean, I told our executive producer I stretch every morning. She was surprised. Anyway.
I can't do anything.
Yes, you can. You have so many skills here. We've also got driving skills here this morning here, watching shares of Carmax after reporting a 33% decline in profit during the first quarter. The shares are actually up by about 2.9%. The company's saying in a statement that headwinds due to, quote, widespread inflationary pressures, higher interest rates, and tightened lending standards continued to impact sales. And yes, they did. Ultimately, they bought 314,000 vehicles from consumers and dealers. That was actually lower. That was down by about 8.6% versus last year's first quarter. They said that was impacted by lower year-over-year seasonal appreciation here, but the retail used unit sales decreased by about 3.1%. Comp store used unit sales also decreased by about 3.8% from the prior year's first quarter.
It was kind of a pick what data point you want to prove your narrative print. I felt this note from RBC kind of sums up the bull and bear case pretty well. I think the bulls, according to this note, are going to focus on gross profit per unit stability and continued cost discipline for the company, and that the worst of the macro environment pressuring this name is going to be in the rearview mirror. Having said that, the kind of bearish view is going to be focused on the retail comp miss coming from this earnings print, and that Carmax is kind of remaining the market share loser here when it comes to some of the data points that we got in from this print. Having said that, the analyst behind that bull and bear case that was just laid out, Stephen Shmemesh from RBC, he is saying that he still maintains his outperform rating on the stock. But I mean, it's certainly been struggling here. You can see that over the past 3 months, it's down 14%. Year to date, down just 7% after having a little bit of a run over the March and April months there. But interesting to see what's going to happen with Carmax moving forward.
Absolutely. All right. Well, we're going to track them throughout this trading session. Also, we're tracking shares of Nikola. Nikola shares reversing course after originally plunging on news of its plans for a 1-for-30 reverse stock split. The move set to go into effect after the market closed on June 24th. Shares of Nikola are down over 60% so far this year. Pre-market, they're catching a bit of a breather, as we mentioned, reversing course here from those deep declines that we had seen on the announcement of this. But I think for Nikola, I mean, look, it's giving documentary. Eventually, there's going to be some type of WeWork-esque or Uber-esque story that's told about this company. I mean, dare I say, Fire Festival type of business story that comes together just with everything that's taken place. The investigation into the founder, Trevor Milton, what that eventually led to after the legal proceedings, and then, of course, just the fraudulence in trying to go out to investors and tell them, hey, yeah, we've got this, it's ready to be produced, and taking on massive amounts of capital in order to produce something that eventually, years later, did not I think we just last year finally saw the first vehicle, hydrogen electric truck, get delivered.
Yeah.
I mean, we've been talking about this for like 3-4 years.
No, it's a great point, Brad. And as some context here, this is the company that provides battery and hydrogen fuel cell electric vehicles. To your point, though, just delivering that truck last year, and this comes amid a week that we've seen a couple of headlines that have been negative for just the broader EV industry. You've got Fisker finally kind of shutting its doors, filing for that official bankruptcy. That led to a little bit of downward pressure for Tesla and some smaller EV stocks as well. So a tough week when it comes to some of these EV-related names. Now, coming up, we got the opening bell on Wall Street. We're going to see where stocks start the day trading and help you parse through the biggest movers of the morning. Right now, you're looking at a mixed picture. The S&P just below the flat line, the Nasdaq just above. We'll cover all of it for you after the break.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market domination. Tune in daily from 3 to 4 p.m. Eastern.
Welcome back, everyone. We are just seconds away from the opening bell here on this Friday. Taking a look at the Dow Jones Industrial Average, flat just barely to the downside. We'll see if we can get into positive territory on that opening cross. Might be a photo start, not a photo finish, of course. S&P 500, you're taking a look at that. That's down by about 0.2%. That's probably going to open in the red. And then the Nasdaq futures right now, that's hyper oscillating, waffling, if you will, coming into the start of today's trading activity. Here's a live look at the opening bell at the NYSE and the Nasdaq, where at the NYSE you've got Infosys. Wow, haven't seen them in a little bit up there ringing the opening bell. Great bunch of folks. You've got the SBA. Is that the Small Business Administration we see at the Nasdaq? It might be, might not be. SBA can mean a lot of different things. But anyway, all of these things considered, you got two great bell ringers. You got a little funfetti and you got a Friday opening bell. Who could be upset? Anyway, taking a look at the major averages out of the gate here this morning. Let's take a look at our major averages that are calibrating. The Dow just barely opens the day in positive territory. You're seeing it flat just barely to the upside. We'll call it about a 0.1% gain here. Let's just populate this chart here so you can see what's taking place throughout the course of this week. Ultimately, we're still seeing gains in excess of about 1% there. The Nasdaq Composite right now barely holding on to gains over the course of this week by the hair of its chinny chin chin. Here today, down. S&P 500, you're seeing that here today out the gate, down, but fractional gains over the course of this week. Maddie, should we take a look at the Dow 30 components? We don't always do that.
Why not?
Get to the
Look at
sectors.
Papa Dow here. It's interesting to see Microsoft continuing to kind of have hold over this market. And I was just looking too at the Philadelphia Semiconductor Index, down a little over 1.25%. You can see here that the kind of more traditional tech names are dominating that Dow 30 here, not necessarily some of those techier NASDAQ names that we talk about all the time. So it'll be interesting to see how the triple witching of it all impacts this as we go throughout the trading day. We are going to get over to Yahoo Finance's Jared Blickery for a broader look at what is moving markets today. Jared, what do you got?
Well, thank you, Maddie, and thank you for the shout out to Papa Dow. I just did a webinar with JC Peretz a few days ago, and that was his message for traders. You cannot ignore Papa Dow. Now, here we're looking at the indices, but I'd be remiss if I didn't add that the S&P 500 and the Nasdaq are now poised to be up 8 out of the last 9 weeks. That's an incredible run, and so a lot of people are wondering, well, is it getting a little bit long in the tooth? Could be the case. We do see some warning signs, but we haven't seen them materialize really in the price action just yet. So let's take a look at the sector action, which I have up here. That's consumer discretionary. XLY is in the upper left. That's leading, but only by 0.4 of a point here. To the downside, we got financials down almost 0.5%, industrials a quarter, tech a quarter, materials down 2, but not a lot of big movements. I do want to focus on Nvidia for a second. Now, you can see it's down another 2% today, and what's concerning some traders on X and other medium is this big red candle right here. And this is actually a bearish engulfing candle. This is when the body of it engulfs the prior day. So the high is higher and the low is lower, and that happens after an up day. So that is a candlestick formation, and you'll note this is a year to date. It's hard to see here, but we had another one of those at the ultimate high, at the then record highs in March, and then we saw a bit of a consolidation. So what I might expect from here is just a little bit of a pause, some sideways action, and then usually the trend resumes, but it doesn't always have to end that way. We're also seeing Micron down about 4%. So let's skip over to the semiconductors here. ARM down 3% as well. So kind of a red board when we're taking a look at tech. Remember, XLK was down 0.25%. And we're going to take a look at software. Look at all this green. Now, what's interesting to me is that software and chip stocks have from time to time recently been trading on opposite ends. So today we're seeing that dynamic in play where we got software, more software up than down. Meanwhile, we got the semis kind of mired in the red. And finally, for our look at tech, I do want to look at disruption. Now, Tesla is up marginally there, but if I look at the equal weight, you can see a lot more red than green. So still kind of risk off with the fringier aspects of the market here, guys.
All right, Jared, thanks as always. Really appreciate it. And great point on the kind of bifurcation that we see in the software and chips sectors as well there. Really appreciate you as always. The S&P 500 and the Nasdaq pulling back from record highs as the Nvidia-driven rally taking a bit of a breather here. Our next guest says it might be time for investors to rebalance their portfolios amid all the tech concentration. Scott Wren, Wells Fargo Investment Institute's senior global market strategist, joins us now. Scott, great to have you with us. Thank you so much for being here. look, in your note, you say the thing that makes us all sit up, it's time to trim tech and comm services to neutral ratings as the S&P 500 is making new highs and investors should rebalance. Why now for that call? Why not just enjoy the tech gains of it all for another 6 months or so?
Well, Maddie, you're right. And you know, if you could pick the top in a momentum market before you have a halfway decent correction, it'd make it a lot easier. But I think right now is what we're trying to do is we think those two sectors that you mentioned, comm services and tech, very highly valued, very momentum driven. And what we want to try to do is trim some of those gains and buy things like industrials and materials, energy. We've also been buying a little bit of healthcare. So we think those sectors are undervalued. The other ones are overvalued. You know, we'd be very hesitant to just go out and buy the S&P 500. But I think you have to look under the hood and do a little bit of work under the hood. And a lot of this is, you know, you need to be patient, and you need to realize that, you know, picking the top in any particular run is always difficult. You know, we want to be invested here. The market we think will be higher than where we are right now at the end of 2025, but we think we'll probably have a bumpy road that'll provide some opportunities and equities between now and then.
Scott, big themes are typically easy for investors to try and wrap their minds around what the runway might look like. And that theme has largely been AI to this point, and generative AI. What is, though, if we were to see some type of rotation or profit taking even and spreading the chips around elsewhere, what are other comfortable themes that investors can be comfortable with for a long-term time horizon right now?
Well, you know, Brad, I think one thing you want to point out is that, you know, industrials and materials, you know, all this AI build out, whether it's data centers, updates to the electrical grid, all those kinds of things, you know, the companies that are going to be building those are in the industrial sector. And certainly there's going to be a lot of copper and other types of industrial metals used, which is in the material sector. So, you know, those two sectors play out with those themes. But I think overall, you know, you need to think about the economy here probably for the next few quarters, 3-4 quarters. You're going to see sub 2% growth in GDP, somewhere between 1.5% and 2%. You know, inflation's going to come down, but it's going to take a little bit of time. So I think right now you want to position for what might, or start to position for what might happen after this slowdown. I think you're going to see the second half of 2025 be better globally. I think you'll finally see these developed international markets, maybe emerging markets, start to do better. But the U.S. is going to lead the charge. So I think for now, you still want to be overweight U.S. relative to industrials. You still want to play the large cap theme. You know, we've been underweight small cap stocks, the Russell 2000, for a couple of years. I think that still has a ways to go. So I think right now you want to just make some moves around the edges. You want to be a little cautious here, but you want to have a plan, because when the pullback occurs, and you know, I'll say, you know, right up front that, you know, we thought we'd see another 10% pullback by now, and it hasn't happened. But it's going to happen at some point. You need to have a plan. A lot of investors, retail investors, have cash on the sidelines. You need to know what you want to buy. And then, of course, when you see a 10% pullback, you have to do the hardest thing for most retail investors, is just to kind of hold their nose and stick their toe in and execute the plan. So we're trying to be patient here. We think you'll have a opportunity at higher rates, a higher 10-year yield to buy some longer duration bonds. We also think you'll have an opportunity to buy stocks at lower levels.
Scott, what causes the 10% decline in the market?
Well, Maddie, I think it's going to continue to revolve around, is inflation going to come off fast enough for the Federal Reserve to cut? We're only looking for 2 cuts this year, and I'm telling you, if we're wrong, I think it's going to be fewer cuts, not more. We're only looking for 1 cut next year, which, of course, the median dot was at 4. So I think it's going to revolve around inflation staying higher for longer, and then at some point, you know, consumers are starting to back off here. We think that'll happen more as the economy slows. So I think it'll be a combination of higher inflation and a slower economy. That'll spook a few people and cause a little bit of money to come out of the market and give you that opportunity.
Scott, with the opportunities, we love it. Scott Wren, Wells Fargo Investment Institute Senior Global Market Strategist. Thanks for joining us here on this Friday, Scott. Great to see you.
Have a great weekend, guys. Thank you.
You too. Meta getting a bullish call from KeyBank. We'll speak to the analyst behind it. That's next. Meta shares are up over 40% so far this year as investors double down on the AI trade. And our next guest says that there's more room to run, raising his price target from $475 to $540, driven by ad momentum. Justin Patterson, KeyBank Managing Director, joins us now. Justin, great to speak with you here. Okay, so take us into the thesis here and what's shifted in the ad landscape and in terms of what you're seeing for the load demand that would benefit Meta versus some of the other competitors?
Yeah, definitely. And thanks for having me. So when you look at just pricing data, so data just on what Meta advertising prices are going for right now, they're actually accelerating sequentially. So you saw about an 8-point improvement from Q1 to Q2 quarter to date. And that's actually against a tougher comp. So what that means is that demand for Meta's advertisements remains very high. It's an auction. You're seeing more advertisers bid higher rates to reach Meta's customers. And that just really shows you that the returns from this AI advertising cycle are still very strong. So when we look to the second half of the year, we don't think the deceleration in growth against some tough comps will be as severe as investors think. And we think there's still potential for mid-teens growth in 2025. When you roll that together, that speaks to earnings upside, free cash flow upside, even against all this CapEx investment.
Let's talk about that CapEx investment, because you mentioned in your case here that Meta is investing aggressively in AI and that could improve the core business. We talk a lot about all of these companies investing in AI. What is it about what Meta is doing specifically under the hood that you feel is a bullish signal for the company?
Yeah, I think it's a couple of things right now. First, you're already seeing the benefits in terms of engagement. So if you go back to the Q1 call, Meta cited several stats in terms of just how this recommendation engine powered by AI is driving more video consumption, more time spent on Meta sites. And that just means there's a lot more ad impressions to serve. The second piece that's really happening is under the hood on the ad tech side. So as you really refine what type of ads people are seeing, provide them more relevant ads, that really boosts the return for the advertiser and encourages them to spend a little bit more on ads, which is what we're seeing in that pricing trend right now. So we really think there's a just powerful flywheel going on at Meta. As these capital investments get some returns, you're seeing better revenue growth come in, and that just fuels a little more investment in terms of data centers.
And just, on this, while we've got you, there's the larger concern about what will happen if TikTok does get banned, if there is no suitor that steps in and purchases and allows them to remain operable here in the US. What does that mean for Meta? What's that mean for the advertising windfall that they may start to get from that too?
Yeah, it's a great question. So if you just consider TikTok, you're getting roughly 90 minutes of time spent per day on the TikTok app that has to get reallocated somewhere. So when we look at it, we generally think that Meta, Alphabet's YouTube, and Snap are the biggest winners from that, just because they all have short form video apps, and that time spent will go back to the Instagrams, the Facebook Reels, the YouTube Shorts, so on and so forth.
Justin, you also cover Spotify. They are hiking prices again. How much is too much?
It's an area that we're always very focused on with our survey where Spotify has been one of our top ideas for quite some time now. We look at our last audio survey, which was published just right around the time of that price increase. We actually saw that consumer willingness to absorb another price increase remained very strong. So if you kind of step back and look at it, Spotify's added a lot of value to its service over the past year with audiobooks, with new features around Gen AI, playlist recommendations in there, that it looks like this should be going through relatively easily.
Do they need to take another stab at video, Justin?
Spotify on video? I mean, you're seeing it already a little bit today, where if you go in the app, you actually see a lot of music video embedded within there. The podcast side actually does have quite a few podcast and video advertisements around it right now. So there's a lot of ways to win with Spotify here.
Right, and I guess I asked that because of the success that they've seen with podcasts. A lot of those podcasts are becoming very common vodcasts now. So it seems like there could be some type of potential play where they would see even more of those core users say, all right, I wouldn't mind viewing the same podcast that I'm listening to, especially when those podcasts are popping up in different cities doing their own tours and whatnot.
For sure. You certainly see it with the Ringer, Bill Simmons, and his platform on Spotify, where there's a lot more just live streaming of video on there. And that does result in a higher price ad, because a video ad is usually worth more than an audio ad in there. Right. So that's one lever to just drive engagement, drive revenue on the Spotify side. And actually, just going back to your TikTok point from earlier, there was an investor concern that TikTok music would come to the US. So you could actually view Spotify as a beneficiary from this too, where if TikTok, is held up on the US side, on the social front, you're certainly not going to see a music app here anytime soon. So the competitive landscape for Spotify still looks very strong today.
Interesting. Okay. Justin Patterson, KeyBank Managing Director. Thanks so much, Justin. Appreciate the breakdown and walking us through both Meta and Spotify here this morning.
Thank you.
Certainly. Everyone, we've got all your markets action straight ahead. Stay tuned. You're watching The Morning Brief.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
The vibe check today. Hacks cause a lot of problems. Auto retailers across the U.S. and Canada could face days of outages due to back-to-back cyber attacks this week on CDK Global. That's a software provider for 15,000 car dealerships in North America. So why does this matter? Well, it shows the impact of cybersecurity on both small businesses, but also the broader economy. And Brad, so many of the guests that have come on our show have talked about this in the context of the AI rally, which is something that is a little bit less tangible. But cyber attacks and cybersecurity is going to be so critical to watch moving forward. These hacks really making that clear as we're hearing reports from small businesses across the country at these retailers saying that they're having to resort to pen and paper, some of them proactively shutting down their systems, saying that they don't have an estimation of when things are going to be worked out with this cyber incident, but the kind of swath of the impact of this attack on car dealerships, again, just one example, but showing the kind of impact and importance of cybersecurity and software moving forward.
Yeah, I'm going to summon a blast from the past name into this chat in BlackBerry, and they had listed out earlier this year the most attacked industries in the cyberspace here. Finance, resulting in about 50% of the attacks. Healthcare, about 20%, which is actually an improvement for healthcare, which used to be the most vulnerable to cyber attacks and cyber threats here. And then you've got that in third place, followed by the government and public sector. But all these things considered, it kind of takes me back to our conversation that we were having on wealth yesterday, really with regard to some of the ETF plays that are potentially out there for investors, especially given the trove of data that is going to be inferenced and leveraged with regard to these new data centers and the new cloud landscape because of generative AI, and now needing to layer on cybersecurity at a much larger or multiple type of realm here. So that's something that we were discussing yesterday, just with regard to some of the opportunity within cyberspace or cybersecurity investments. Particularly, there are two that continue to come to mind for me. Over the years, I've been tracking CIBR and then HACK as well. Those two of the largest cybersecurity ETF plays that have been out there and most discussed by some of the experts in the industry as well, especially as you see any type of ramp up in spending to be more proactive in protecting consumers' data or business data as well here, or just grids. I mean, there's going to be so much more cyber spending that is done. And there you're taking a look at the First Trust Nasdaq Cybersecurity, CIBR, on your screen right now. It's down here on the day, though.
Yeah, it's interesting because we are seeing some of the cyber names up on the day, but that could be part of kind of the macro discussion that we were even having with Jared earlier today, that the chip sector and software sector tend to move in different directions. We're seeing a lot of pressure on the chips names this morning, seeing some upward movement in the software and cybersecurity space. You've got Palo Alto moving to the upside, up about 1.5%. You've also got a name like Datadog up as well. So it's interesting to see kind of that upside movement coming from those names, given that the cybersecurity question continues to be a big problem in the overall market space. I mean, this is just one of several stories that we've heard about over the course of the past year, right? I think about an AT&T hack. We don't have the final word on what that was, but seems like it was probably a cyber attack. It's just, it leads to this question about the importance of cybersecurity moving forward. Well, coming up here, we're going to dive deeper into the catalyst moving markets. Later, Yahoo Finance sits down with Boston Fed President Susan Collins for an exclusive interview. You won't want to miss it.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
10 a.m. here in New York City. Happy Friday, everyone. I'm Madison Mills alongside Brad Smith to kick off our show. Let's dive into the catalyst moving markets today. We got a fresh read on the housing sector. The latest data on existing home sales signaling continued pressure for the housing market as higher mortgage rates weigh on buyers.
And we're getting a fresh read on the economy. S&P Global's flash U.S. services and manufacturing PMI beating expectations, showing the economy is gaining momentum. We'll explore what this could mean for the Fed.
And Nvidia is looking to claw back its losses after pushing stocks to new heights this week. But the tech rally is still showing signs of fatigue. We're going to break down why tech can't be the only catalyst to move markets to newer and higher highs. But first, some breaking news. The S&P Global U.S. PMI Composite this morning. We are getting in for June, looking like it came in at 54.6 versus the 53.5 estimate here. And that is a kind of a solid set of PMI figures. The headline component of every aggregate is beating expectations here. The services and composite readings hitting their highest levels since April of 2022. We're seeing that yields are jumping, stocks fading a little bit off of those numbers, moving further to the downside. We had seen a little bit of flatness and negativity heading into the morning here, but seeing stocks pushing even further down. Your S&P is down about 0.2%. The Nasdaq is down 0.3% off of that data, again coming in hotter than expected. And it's really not surprising given kind of the activity components that we see in this print. We're seeing 10-year yields sort of coming back even further off of that 4.2% mark, given some of that data that we got in this PMI print under the hood, Brad.
Yeah, some context to this report as well. The improved business confidence for the year ahead, notably in the service sector, as well as renewed pressure on operating capacity from rising demand, meanwhile encouraging firms to boost payroll numbers for the first time in 3 months. That is part of the overview in this release. But to your point, Maddie, U.S. business activity growth accelerated to get this, its fastest in 26 months in June, according to this provisional PMI survey data from S&P Global, signaling a strong end to the second quarter. The service sector leading that upturn with additional support from manufacturing, and they mentioned, albeit with the latter's recent revival, losing some momentum here. So that's some of the context around this U.S. services PMI data that we're getting out this morning, a little bit hotter than expected, as you mentioned.
Yeah, that's exactly right, Brad. We also got a fresh read on the housing sector. Existing home sales slightly declining in May as the median sales price did climb to a record high. That is according to the National Association of Realtors. Now, in the 4 major U.S. regions, sales did slide month over month in the South, but were unchanged in the Northeast, the Midwest, and the West as well. You're looking at 4.11 million existing home sales for the month of May. And again, that is a retreat of about 0.7% from April when it comes to those existing home sales numbers here. So it's interesting, particularly given some of the data we've gotten earlier this week, to kind of take a step back and look at particularly the inventory rising to 1.28 million homes from a month ago. And interestingly, first-time buyers, you like this out of wealth, Brad, 31% of total sales made up of first-time buyers, all cash 28%, investors 16%. So that is interesting that we're seeing some more first-time buyers heading into the space, but still seeing a lot of all-cash purchases, which indicates what type of individuals are able to purchase homes in this higher-for-longer environment.
Yeah, properties, they're saying, typically remained on the market for about 24 days in May. That's actually down from just 26 days in April, but up from 18 days in May 2023. So that's your year-over-year comparison. And then additionally here, looking at, and this is potentially interesting to keep tabs on, this all-cash sales figure accounting for about 28% of transactions in May. That's unchanged from April and up from 25% 1 year ago. And why do I bring that up? Because you've got even more of the higher end or high net worth individuals or households that are still looking at where those buying opportunities may be right now before you see a flood of people enter back into the housing market and the home buying market, especially with the prospect of potential cuts. And so that is something that a lot of people still sitting on the sidelines for potentially here. That continues to come up in many of our housing market conversations. But again here, I mean, the key thing to take away here, the total existing home sales, completed transactions, including single family homes, townhomes, condominiums, ultimately retreating by about 0.7% from April here in this most recent reading.
All right, Brad, well, we are going to get to a conversation about this data with Lawrence Yun, the National Association of Realtors Chief Economist and Senior Vice President of Research. Lawrence, thanks so much for being with us just as we are getting this data in. As Brad was mentioning, that headline down 0.7% from the prior month. What sticks out to you about this data that we're getting in that you think kind of defines what we are seeing and what you're seeing in the broader housing market right now?
Good morning. So the home sales decline of less than 1%. I mean, that's essentially unchanged. In fact, home sales have been stuck at that 4 million, little above, little below that level for the past 12 months. So nothing exciting related to home sales. I mean, I'm a little frustrated that we are not seeing a recovery. You know, that's partly due to the delay in the rate cut decision by the Federal Reserve. But what's striking is all-time high in the median existing home price. So we are now seeing some acceleration in prices. Multiple offers are still happening in the marketplace. Maybe one welcoming news, potentially a forward leading indicator in the future, is we are getting more inventory. So as more inventory begin to show up, maybe more consumers recognizing there are more choices will consider reaching into the market.
Yeah, it's really interesting, Lawrence, especially when you were talking about the number of bids and multiple bids that are being made for properties here, and especially how that cascades through to, or at least translates through to, the amount of days that properties remain on the market, that edging just slightly lower, at least sequentially here, but still up from what we had seen last year. What's your estimation or evaluation of how, if we were to see rate cuts, we would see even more bidders hop into this market?
Yeah, you know, the mortgage rates, that is a highly influential factor for home buying. We always see when the interest rate decline, there are more buyers coming into the market. Now, good thing that we have more inventory, but I also believe when the interest rates are cut or steadily decline, we will actually have more sellers coming onto the market. We know about the golden handcuffs, people loving their 3%, 4% mortgage rate, not willing to give that up. But there are life-changing circumstances where maybe perhaps people have reached the retirement age and they want to trade down. Maybe some young households where they have a starter home, but they need a larger size home now, so they will put their starter home onto the market. And all this job changes that's happening across the country. People have different job, different location, but the same house, which means that commuting patterns have changed. So I think it's just inevitable that the strength of the golden handcuffs will steadily weaken over time, but it will weaken even more when the interest rate decline. So expect more buyers when interest rate decline, but also expect more sellers to come onto the market as interest rate decline.
Well, it's interesting that you point that out because there's this question out there about what interest rates are going to do to home prices. And I'm curious from your perspective, when we do at some point get that initial cut from the Federal Reserve, what does that do to demand in the month after that? And what does that do to prices just in that immediate reaction after that cut?
You know, the mortgage market, which is not directly controlled by the Federal Reserve, so the mortgage market will be moving ahead of the Fed decision based upon how they communicate when it is likely to be rate cut. So the movement of the mortgage rate will not happen on the day of the Federal Reserve decision, but rather maybe even a couple of months prior to that. So as a consumer, they should always be on the lookout as to what's happening on mortgage rates, say this week, next week. And if the right property comes onto the market at their within their budget, maybe just give it a try and to see whether or not they can get a little discount. Now we have more inventory, and certainly a good news for consumer choices.
All right, Lawrence, we're going to have to leave it there. Thank you so much for joining us. That was Lawrence Yun, National Association of Realtors Chief Economist and Senior Vice President of Research. Well, we're still keeping our eyes on Nvidia shares this morning. The chipmaker feeling some pressure, but on track for weekly gains depending on how the day goes for this stock. It's hard not to find an Nvidia bull shrugging off these recent losses. Take a listen to what Patrick Moorhead, More Insights and Strategy founder, CEO, and chief analyst, had to say about it earlier this morning.
But I don't see any reason why this couldn't get to $4 trillion if we continue to see those positive signs down in the channel, and we keep seeing positive news coming out from Nvidia with its partners.
And of course, he's mentioning the partnerships with HPE, Dell, XAI from earlier this week, Brad. But one data point that I haven't pointed out this morning yet, 58% of stocks gained yesterday, but the overall index fell. That is just one example to put into context the degree to which Nvidia has a chokehold on this overall market. But to Patrick's point about kind of the partnerships and the other companies that are leaning into the AI space, I wanted to point something out from LucidWorks this morning. They have a note saying that the proportion of global companies planning to increase spending on AI over the next 12 months has slipped to 63% from 93% a year earlier. If we do continue to get companies sort of decreasing their capex on AI, what does that do to an Nvidia moving forward? That might be why you have a Scott Wren saying, hey, it might be time to trim your exposure to tech and comm services a little bit, given what we might be anticipating and the amount of concentration that we're seeing with Nvidia.
Look, I mean, when you think about Nvidia and what it has been to the markets thus far, I mean, it no doubt has been this market's Jason Tatum, if you will, if you're looking for an NBA reference out there, because why not? We're just off of the NBA Finals concluding. But one of the huge things to think about is both current returns and also future anticipated returns as well that we're talking about. And that's where I think about some of the analogous kind of energy from what the Boston Celtics have seen most recently. But all these things considered, now it's the broadening. Where do other players start to benefit? Where do they see their stock rising as a result of it? Jaylen Brown saw that. You saw that throughout the rest of the entire Boston Celtics team. Drew Holiday, who has seen success both with the Milwaukee Bucks and here with the Celtics. All these things considered, I mean, it's the whole team that Nvidia is bringing with it, and that's where it kind of gives me back into the sports realm. I'm not even a Celtics fan. I'm just excited to talk about that, plus the analogous nature of what Nvidia has been able to do as of right now.
Absolutely. I love that you've always found a way to
You just got to paint a picture sometimes.
Bring that NBA reference in, Brad. We love it. All right. We are going to have all of your markets action ahead right here on Catalyst. You're looking at a mixed picture, but some move to the downside in the S&P and the Nasdaq. We'll cover all the market action after this. Shares of Denmark's Zealand Pharma are moving to the upside here by over 17.5% after an early stage study of its weight loss drug Challenger produced positive results. Yahoo Finance's Anjali Kemlani has more. Anjali, what do we need to know about this?
Well, first I need to emphasize it's not a GLP-1 drug, so that's good news, I guess you could say. But Zealand announcing the phase 1B results, looking at 48 adults in this trial. They lost 8.6% of their body weight on average after 16 weeks, and that is positive news. That means that it is another option outside of what we know as a GLP-1. It's a different type of product than what we know, similar to an AstraZeneca drug that is currently out on the market that is used for insulin production. It's for diabetes users, but that is a shorter term, sort of like a short-acting insulin in the sense that it works more quickly. This is a longer-term, once-weekly injectable, so it does prove to be a possible contender on the market for those GLP-1 injectables that we have now. So good news, again, early stages. We'll have to see if the results hold in bigger trials.
Well, Anjali, it paints this broader picture and leads to this question about kind of the competition that we are starting to see in this space. You and I have spoken about some of the competitors that are kind of offering the compounded versions of the drugs. You'll explain it better than I can. How much of a headwind, though, is that for the companies that are offering the FDA-approved versions of the drugs?
So the good news is that demand is still more than supply. So right now, it's actually helping the market to get more people onto, at some level, these drugs. Now, I would say that, of course, the FDA would tell you, and these companies will tell you that they prefer you stick with the branded approved versions because some of these compounds are being approved or being allowed, rather, not approved, allowed because of the shortages. So the FDA has allowed these companies to make these compounds, but that doesn't necessarily confirm their safety or their efficacy. I know some people have used them and said they're okay, but I would just say that broadly speaking, demand is still outstripping supply right now. So you are going to see some of these continue. You're going to see these online offerings. I know Lilly has been pretty strong in kind of going after some of these compounded products and some of these medi spas that are offering things that are not FDA approved. So certainly stick with the brands, I would say.
Right. And a great distinction. The FDA approved and not FDA approved could be different formulas, all those kinds of things. Anjali, thank you as always for bringing us your great reporting. We appreciate it. We're going to have all of your markets action ahead right here on Catalyst. The downside movement not looking as downy as it was previously. You're looking at about flat on the S&P 500 and the Nasdaq just tipping over to the downside. The Dow is up so far in the trade. Stay tuned. You're watching Catalyst. The latest manufacturing data out this morning showing signs of the economy gaining momentum. For more on what that could mean for future Fed decisions in the broader market, we have Jack Manley on set. He is JP Morgan's asset management global market strategist. Jack, thank you so much for coming in studio with us. Talk to me about this PMI data coming in above expectations. How much of a driver is that going to be of the market?
Well, I think markets seem to not be particularly thrilled with the PMI data, but I'm so frustrated, Madison, with this idea that good news is bad news. Like, I think that story is so played out at this point. And I think the problem is that we have totally lost the plot on what interest rates are all about. And we have convinced ourselves that the Fed wants a recession. It does not. That is not in its mandate. The Fed does not want to crush the economy if it does not have to. We're not supposed to be rooting against the economy accelerating. That is a good story. And as long as the inflation data remain relatively in the right place, moving down to that 2% target at some point, as long as the labor market stays reasonably hot, I think that the Fed is going to be able to do what it wants to do this year, which is ultimately cut interest rates. So I'm not paying too much attention to the PMIs. I don't care that they beat. I don't think it's a big story, but that's what markets are all focused in on.
But let's talk about the kind of tenor of your tone on the Federal Reserve right now, because it's a fascinating point, and I think it points to this question about the Fed losing the plot and not really having a driving thesis behind just, oh, we're data dependent, but what does that actually mean?
Yeah. I wonder if the Fed is actually data dependent, frankly. I mean, I don't think the Fed has done a particularly good job of managing monetary policy at all throughout this entire cycle. And I think you have to rewind the clock a little bit, right back to 2022 when they first started doing this stuff. But it blows my mind that quantitative easing lasted as long as it did, that rates stayed at zero for as long as they did. The U.S. economy was fully out of the COVID slump by the fourth quarter of 2020. Why were we remaining so accommodated for so long? If the Fed were truly data dependent, those rate hikes would have happened a year earlier. The end of QE would have happened a year earlier. The Fed is not always data dependent. They rely a ton on forward guidance, which is why they put out these summary of economic projections like the one that we got last week. So I'd rather than trying to like game out exactly what the Fed's going to do, I think it's really, really hard to get inside their heads. And of course, we don't know what the data are going to look like over the next several months. I'd rather focus in on some things that I think are a little bit more tangible, a little bit more predictable as investors. Fed's probably not going to hike this year, right? So we can kind of put that off the table. They seem more likely than not wanting to cut at least once. I don't know if it'll be more than that, but at least once this year. Once they start to cut, they're not going to stop cutting immediately. They're going to continue to cut. And wherever they land is going to be a whole lot lower from where we are right now and a whole lot higher than zero, which is where we were for basically the last 15 years. That allows you to sort of put aside a lot of the short-term uncertainty. I don't know what's going to happen to rates over the next 6 months. I don't know what's going to happen to the data over the next 6 months. But I do have confidence that rates will move lower over that longer-term time period. And that, I think, gives me a little bit more confidence in the outlook for stocks or bonds.
Do cuts matter for the market specifically?
I think if the Fed were to surprise and not cut, that's bad news for the market. But at this point, things are all priced in, especially after last week's meeting, the Fed kind of affirming what the market was already looking for, 25 basis points of cuts. I think if the Fed does cut, let's call it September, October, November, sometime, end of third quarter, start of fourth quarter maybe, the market's expecting that it's not going to be a party, right?
So then for us to continue to get new all-time highs, I know you expect earnings to broaden out, but we're also seeing some signs of a slowing economy. How do you find that earnings growth amid the potential struggling consumer environment?
It is admittedly challenging. I think we have to remember, though, that the consumer is, in general, still pretty resilient. And a lot of the problems that we see in this consumer right now are disproportionately focused on the lowest income individuals in this country, which is a shame, right? I mean, you have to put that out right up front. That is really too bad. There are a lot of people out there that are getting completely left behind. And that growing divergence between the haves and have-nots is, I think, one of the reasons why you've seen populism become so popular in Washington, right? It's this idea of kind of bread and circuses because there are so many people getting left behind. But from an economic perspective, the U.S. economy counts the dollars that are getting spent and not the heads that are spending them. And I love anecdotal evidence. I always share anecdotal evidence because I get to see a lot in my travel for work. And I'll tell you, like, the first class cabins on all the airplanes, they're sold out. The hotels are all sold out. The restaurant reservations are impossible to get. Concert tickets are impossible to get, right? NBA Finals wrapped up last week. Like, can you imagine how much a ticket to one of those would have cost and standing room only, right? I mean, people are still spending. The consumer is still doing well enough. And I think that helps to support this broadening out of the earnings story. It's not going to be everybody, right? There's still going to be winners and losers. I think you got to be really, really careful. This is not necessarily a beta trade. I do think you need a little bit of security selection, a little bit of active management. But to me, the biggest story as we look for that broadening out of earnings in the back half of this year is an emphasis on quality in your allocation. This is not a style box story. It's not a sector story. You are fishing in too big of a pond. Quality is what matters because of that rate outlook that we just discussed. Money's not free anymore. And even once the Fed starts to cut rates, it won't be free again.
Yeah.
That, I think, informs the decision.
And it's stock picking. We're going back to that environment where you really got to look at the fundamentals for each investment opportunity. Jack, thank you so much for coming in. Really appreciate it. Great insights as always. Thank you so much. Well, the market is keenly focused on Fed moves and Fed speak. We rarely get a look at the day in the life of individual Fed members. For more, we bring in our own Jennifer Schomburger, who had a chance to sit down with Boston Fed President Susan Collins earlier this week. Jennifer.
Thank you, Maddie. The Boston Federal Reserve invited me to spend the day with President Susan Collins earlier this week in her district in Lawrence, Massachusetts, where she talked to local bankers, community developers, and businesses, gaining information firsthand on the ground about the economy, information that she uses to gain an overall picture of the economy for decisions on setting interest rates. Susan Collins is one of the most powerful people in America. The president of the Federal Reserve Bank of Boston, the first woman of color to hold that position, belongs to a select committee in Washington, D.C. that decides whether interest rates should go up, down, or stay the same. We had an exclusive peek into how she makes decisions that influence what you pay to borrow money for a home, car, or what a bank pays you to open a savings account. The Fed has held rates at a 23-year high in the range of 5.25% to 5.5% for nearly a year as it tries to tame inflation. And right now, Collins and her colleagues at the Fed are wrestling with a vexing question. Has inflation cooled enough from its pandemic highs to start cutting rates?
We're going to have to let the data really tell us when it's clear that we're sustainably on a path. And that means looking at a wide range of data.
In June, the Federal Reserve opted to hold interest rates steady in the battle to bring down inflation. It signaled just one interest rate cut this year. Part of the decision for setting interest rates is from information gleaned by regional Fed bank presidents on the ground in towns and cities across their districts, like this one in the 1st District, which spans 6 states from Maine to Connecticut. Collins monitors key data from the Personal Consumption Expenditures Index to the monthly jobs report for clues on the direction of inflation and the economy. But it's also important for her to talk to local businesses, banks, and consumers to see if the official data line up with what she's hearing on the ground.
A lot of the data is telling us what happened last month or last quarter. And when we talk to people, they're telling us what they're seeing right now. They're telling us about their plans and how they see things evolving. And so that's one thing that's important. It also helps to kind of flesh out what the data are telling.
We were invited to follow Collins around for the day in Lawrence, Massachusetts, a former textile town 28 miles north of Boston that's seeing a renaissance. Collins started her day hearing from a local group of bankers and real estate developers who discussed how investments made in refurbishing low-income neighborhoods have fueled the local economy's redevelopment over the past 10 years.
Why don't we start with introductions? Let's go around the table.
She went on to hear about the impact inflation is having on local businesses and the desire for lower rates.
The cost of living is getting out of control, and the rent is something, let me tell you, extremely out of control. Extremely out of control.
One of my key takeaways was really understanding some of the challenges that the higher inflation that we had endured is creating, especially for smaller businesses. And the fact that labor markets are actually improving. It's getting easier for people to hire, and there's much less turnover.
Despite the Fed's dual mandate of promoting maximum employment and stable prices, inflation has been the greater focus for the Fed as it's opted to hold interest rates steady while other central banks have started cutting rates. After a scare earlier this year that inflation may be stalling or reaccelerating in the first quarter, the latest readings confirm prices aren't accelerating, but may be moving down slower than thought.
It's inflation. We're all consumers at the end of the day. We all buy food at the end of the day. And our biggest challenge over the past 3 years has been, how do we provide a high quality product at a price that people are willing to pay?
The data suggests an economy with demand and supply coming into better balance, which is what's required in order to restore price stability. But this process may just take more time than previously thought. It's too soon to tell whether inflation is durably on a path back to 2%.
What Collins and her colleagues watch closely is the Fed's preferred inflation gauge, the so-called Core Personal Consumption Expenditures Index. It showed inflation grew at 2.8% year over year as of April, a level unchanged from March. Another measure of inflation, the more popularly cited Consumer Price Index on a core basis, rose 3.4% in May, cooling from the 3.6% increase seen in April and 3.8% in March. Both are still above the Fed's 2% target. Jonathan Isaacson is CEO of Gemline, a business based in Lawrence which prints custom logos for companies on a variety of swag, from bags to hats and even coolers. Gemline is one of the largest employers in the city, and Isaacson says he hasn't been able to push through price increases to customers.
The time of being able to just hand off price changes is now over from our perspective. During COVID, we did pass through a number of price changes and everybody understood it. Today, things seem to have normalized and people just aren't accepting it anymore.
For economists, that's one of the first indicators that inflation is likely to gradually come down.
I think the data that we have seen recently in terms of CPI, in terms of the producer prices, is consistent with an economy that in an orderly way is becoming better aligned. But we also first quarter saw news that was more disappointing, and the inflation numbers in particular, but other data as well, those monthly numbers are really volatile. The volatility is still quite elevated. And so I do think we have to be patient.
Collins and her Fed colleagues don't expect to lower rates until they gain greater confidence that inflation is moving sustainably toward their 2% target.
Is September too premature to think about cutting rates? Are we looking at something later in the year, more like November, December?
I think we're going to have to let the data tell us. So it seems to me that there are very plausible scenarios where we, later in the year, it would be appropriate if we see strong, continued good news on inflation and an economy that is aligning.
Are you looking at 1 or 2 rate cuts at this point, given where things are?
I could imagine scenarios that would be consistent with both. I mean, I think that as I look forward, my view of how much easing might be appropriate this year has been reduced as I looked at the data.
Collins is also watching for any signs of a slowing economy, which would help the argument for lower rates. The official data indicate the economy may be cooling. Growth in the first quarter slowed to 1.3% from 3.4%. But on the ground in Lawrence, Julie Thurlow, CEO of Reading Cooperative Bank and chair of the American Bankers Association, says the economy looks resilient based on demand for loans outside of housing.
I'm optimistic that a soft landing is in our future. We still see demand. Consumers are still spending. Interest rates are high, but I think it's more of a structural problem that we have as far as housing is concerned.
Collins says she sees a solid economy overall that's showing healthy signs of cooling.
What I see in the statistical data is certainly evidence that the economy is coming into better balance. There's been some slowing in demand, but an economy that's still solid. But it's still quite mixed. There are differences across sectors, there are differences across regions. And what I heard today, it's very consistent with that in the sense of some firms that are still seeing quite strong demand and others where they're seeing consumers being a bit more cautious in terms of their spending.
What's the risk that in the quest to gain confidence that inflation is dropping sustainably back to 2%, that you hold rates at current levels so long that you sow the seeds of a recession?
So the risks are absolutely two-sided, and both sides of our mandate are top of mind for me. So I do think that there is a risk that if we held too long, we would see more slowdown than we need. And that's something that I watch carefully. I think that labor markets are still strong. I think they are not overheated the way that I would have described them earlier, but continuing to watch what's happened across a range of indicators in that space is also important in terms of the timing that will be appropriate to change the stance.
So the soft landing still in place?
Well, I continue to be that realistic optimistic that we're going to bring that inflation down, but we're going to do it amid a labor market that stays quite healthy. And, lots of uncertainty around that, but I still see that possibility as being very much the path that I believe and hope we're on.
My big thanks to Susan Collins and the Boston Federal Reserve for the opportunity to learn firsthand and share with the public what Fed officials do to make decisions that really affect each and every one of us. Maddie?
Jennifer, thank you so much for bringing us the fantastic conversation and for also getting access to Susan Collins, Boston Fed president, for the full day. It was really wonderful to see your reporting work at hand there. Appreciate it. We're going to be right back. We're going to be right back with more right here on Yahoo Finance, so stay tuned. Do you know what the highest grossing film of 2023 was? It was actually Barbie, which grossed almost $1.5 billion at the box office. I contributed a couple dollars to that. Our very own Brian Sazi went to the Cannes Lion Festival in France this week and sat down with Mattel's CEO, Ynon Kreiz, to discuss how the company plans to continue expanding its IP beyond the toy aisle. Take a listen.
Ynon, first off, thank you for joining us. And then secondarily, congrats on your award, the Entertainment Person of the Year here at Cannes Lions. You must be incredibly proud.
Well, thank you, Brian. Great to be here with you. And yes, I'm very honored and humbled and happy to receive this award on behalf of everyone at Mattel, who had so much to do with our incredible journey over the last few years.
This isn't your first rodeo here at Cannes Lions. At this point in Mattel's life, what brings you here? And then what are you hoping to achieve?
We came here as a team of people from Mattel to interact and engage with partners and the creative community. Mattel, at the core, is a creative company driven by innovation. And we very much look forward to continue to evolve our brand messages and continue to transform the company as we really embrace creativity and celebrate the appeal of our brands around the world.
I just want to acknowledge the obvious. We're on a beach at the pier, Cannes Lions, the Yahoo Beach House. We have an umbrella here. It has started to rain, so bear with us as we have this conversation. It's just the reality of the French Riviera. How should investors think about your company now at this point? I see you at this event, a lot of creators here, a lot of media folks. Is Mattel a media-forward company?
Mattel is a leading global toy and family entertainment company. As the owner of one of the most prolific portfolio of children and family entertainment franchises in the world, we have a unique opportunity to both continue to grow within the toy aisle and our core toy business that is performing well, gaining share. And last year we had the highest share gain ever in the history of the company in the US, and continue to capture value outside of the toy aisle through entertainment. And this is not just movies, but also television, live events, consumer product and merchandise, digital experiences, music, and other verticals that are all driven by big franchises, big brands. And this is very much what we bring to the table in a world where everybody is looking for big franchises that really elevate and pierce through the clutter market with unlimited content, unlimited ubiquitous distribution. Everybody's looking for big IP, big brands.
And you have it. So what does that portfolio look like? You know, as you try to capitalize on the major success of Barbie, how many films and TV shows do you have in development?
We've announced 16 movies in development with some of the most creative partners in Hollywood. And we're very excited about some of these projects. All of these projects have a unique opportunity. We recently announced Masters of the Universe that will be released in June of 2026.
That's something from my time in the 80s.
I know, we talked about it. We talked about it before.
Wow.
I know you're a big fan.
Big fan.
So that's an exciting project. This will have a theatrical distribution. It's with Amazon as a partner, but it will also have a theatrical distribution. We recently announced Monster High, another one of our big franchises in partnership with Oscar-winning Akiva Goldsman, as well as Universal as a distributor. We have American Girl in development with Temple Hill, which is a great producer, and Paramount Studios. And Temple Hill produced the Twilight series, so very prolific creators. And the partnerships are really exciting in terms of the opportunity to take our brands and reimagine them for in theatrical distribution and big movies.
I'm just going to hold this umbrella here momentarily. It is what it is. Should investors think that every piece of content that you put out there is going to be a home run? And how do you manage expectations?
Yes, we're not saying that every movie will be the next Barbie, but we absolutely intend to apply the same approach, the same methodology of collaborating with leading talent, amplifying their creative vision, and infusing brand purpose and cultural relevance into all of our projects. And this is very much what defined the Barbie movie. The success of the movie, of course, was about a creative collaboration, the ultimate creative collaboration, but it was really driven by the strength of the Barbie brand and the purpose and the cultural relevance that Greta Gerwig brought into the picture. Of course, with incredible cast and a great story. But the foundation is a very strong brand that has a large built-in fan base. And the same approach, the same methodology will be applied to all of our projects. Our brands have a built-in fan base. And while not every movie will be the next Barbie, the opportunity can come from anywhere. It doesn't need to be a big brand that will drive success. So and of course, by taking multiple shots on goal with different partners, different creative executions, different distributors, each movie has its own path to be successful. And for Mattel, a movie doesn't have to reach the same level of box office success for that to have a commercial impact. And so we're very excited by this slate. It's a portfolio approach, a portfolio strategy, and you will see how it unfolds in the coming years.
Is it hard to compete for eyeballs? And I bring this up because I was talking to Kevin Mayer over at Candle Media, and he has a whole bunch of content coming out too, and he's focused on taking his company to a whole other level, content-led. but there's only so much content that could be out there. Are we just at some point of saturation?
I think what Mattel brings to the table is a very strong portfolio of heritage, beloved brands that are societal, that have cultural impact, that already have a large built-in fan base that go back 2 and even 3 generations. And that is very unique. And if you look around, very few companies, if any, have the quality and strength of the brand portfolio that Mattel can play with. And we have a lot to play with and a lot to play for. And Barbie was an obvious example, but it's not just about Barbie and not just about movies, because our brands resonate in culture in a way that very few franchises do. And what is unique about our brands is that the fans that follow these brands, they have an emotional connection with our franchises. And that elevates your starting point. So when we take a project to the market, we don't have to build it from scratch and create awareness and build this relationship. It's already there. And once you have that in place, with strong creative collaboration and, of course, great experiences, great stories, great movies, great television series, great narratives, you can create things that stand out in a crowded market. And the point is that in a world of so much competition for share of mind, unlimited offering of content and ubiquitous distribution, the importance of big brands is higher than ever. And this is exactly the opportunity that we have. And what is unique about our journey is that we also have a toy business that is profitable. We expect it to grow and continue to grow and gain share. And this is foundational because once you have that established, you can, of course, continue to grow and expand outside of the toy aisle with that strong foundation.
No other host is holding an umbrella. I just want to make that point only for you. No, it's okay. You are a distinguished guest. No, you're the entertainment person of the year at Cannes Lions. You cannot hold this umbrella. How concerned are you about? We've talked about this in the past, but it's something that I've been thinking a lot more here on the ground the past week. How concerned are you about the end game for linear networks? Of course, I'm sure you've seen the difficulties at Paramount. ABC is dealing with challenges at its linear networks because of streaming. What's that end point? Is there a breaking point?
Yeah, the world is evolving and technology is clearly having an impact on not just on distribution platform, but also in the way people consume content and how to engage with it. And of course, screen time is higher than ever, except that it comes in different forms. And the importance of entertainment is higher than ever. And as the owner of the underlying rights of your intellectual properties, we have the opportunity to capture attention and engage with fans wherever they spend time. And our job is to find and engage with consumers and fans wherever they are. So the fact that you own the underlying rights, as opposed to having to license rights for a particular medium, gives us the opportunity to continue to engage and commercialize our properties outside of the toy aisle in exciting ways, in new and exciting ways.
Lastly, you don't win an award like you're winning here if you're not working your butt off over the course of decades. For those on Yahoo Finance that may not be familiar with your career path and trajectory, how did you get this job?
Well, I was on the board of the company and was offered an opportunity to come in and lead it, initially as chairman and then as CEO, at a time when the company was going through a transformation. And we've been very focused on continuing to growing our toy business. And you've followed the story, so you've seen the turn of our toy business, our category structure, the strength of our brands, how we continue to win share, and lead with innovation, continued innovation of our product. And the journey for Mattel as an IP company, a company that is based, the strategy is based on the strength of our portfolio of IP, how that continues to evolve, and how we start participating in other verticals. And we've been at it for years. We're now at the inflection point where our entertainment offering is starting to come into its own fruition. And you will see more and more projects, movies, television series, parks, digital experiences in games.
So you're not beyond the inflection point? You still see yourself as, is Mattel still a turnaround, or you're beyond that?
We're not in turnaround, but we are at the point where our entertainment strategy is coming to fruition. We're still early in the strategy, even though we had some very strong success and clear showcases for the potential of our IP, the potential of Mattel Films, television, digital parks, and the other opportunities we have. Digital, we have a very successful digital partnership with NetEase for mobile games. And there are multiple examples, whether it's parks or the new television series that we recently launched on Netflix for Hot Wheels, that has been a top 10 series on Netflix in 69 countries in its first week. So we're executing very, very successfully in each of the verticals where we participate. Now it's about scale. The question used to be, can your brands translate to opportunities outside of toys? Then the question was, can you do that? Do you have the experience and the capabilities? Now is, can you do more of it? No, not whether your brands do it or you can do it, but whether can you do more of it? And of course we can, and of course we are. Now it's about scaling it. And this is exactly the stage where we're at, and I'm very excited by the opportunities ahead.
Well, good luck on your journey. Let's get you out of here, because I actually think it's going to start to lightning soon. Mattel Chairman and CEO Anand Karai, thanks for always making time for Yahoo Finance. We'll see you soon.
Canada is reportedly repairing tariffs on Chinese EVs to get more in line with U.S. and EU policies. That's according to exclusive reporting from Bloomberg News. Yahoo Finance's Rick Newman has the details for us. Rick, what do we know?
Right. China, it looks set to do what the United States and the European Union have done, which is impose a set of tariffs on Chinese electric vehicles imported into the country, effectively raising the price of those imports so that they don't undercut domestic models dramatically. So the United States, President Biden recently did this, and those tariffs basically are around 100%. So it doubles the price of the import. In Canada, they're talking about a tariff of around 48%. So that would be about half of what it is in the United States. And, countries and blocs such as the EU, they can raise or lower these tariffs based on what happens. I think if you have a 48% tariff on Chinese electric vehicles, as Canada is considering, it's still possible China could import those vehicles the importers would pay the tariff, and those vehicles are so cheap to start with, they might still be competitive in the domestic market. Some analysts here in the United States have said it's possible that even with 100% tariff coming into the United States, Chinese electric vehicles still might be comparably priced to other models or even a little bit cheaper. And there's a real debate here because from a green energy perspective and for addressing climate change, you want the most rapid adoption of green energy technology you can get, such as electric vehicles. And the cheaper the products are, the faster the uptake rate will be. So there's a trade-off here. We're going to adapt over to EVs slower if we keep the cheapest vehicles out of the market. But look, I mean, domestic politics is powerful in all of these countries. And when it comes to protecting something as important as the domestic auto industry, whether it's in Detroit, in Germany, in France, or in Ontario, Canada, the pressure is on the politicians to do it.
The pressure is certainly on, Rick. Thank you so much for joining us. Happy Friday. Have a great weekend.
See ya.
Coming up, we've got wealth dedicated to all of your personal finance needs. Our very own Brad Smith is going to have you for the next hour, so stay tuned. Have a great weekend.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
we're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, Wall Street is bracing for a triple witching. We'll explain what exactly that is, if it has anything to do with hocus pocus, and whether or not you need to take your action in your portfolio. And new housing data shows high mortgage rates are still having a negative effect on buyers. We'll dig into what it'll take to see some bigger recovery in the housing market. Plus, diving into life insurance. Do you need it? And if you do, how do you pick the right policy for you? We've got you covered with a breakdown from Yahoo Finance contributor Ross Mack. All that and much, much more here on today's show. But our top story today for the markets, Wall Street bracing for a triple witching. Here to explain what that is and whether or not it affects your portfolio, we've got Yahoo Finance's market domination co-anchor, Julie Hyman. Hey, Julie.
Hey, Brad. Well, witching sounds spooky, right? And that's because it is named after the sort of witching hour, the wee hours of the night when no good things happen. But in this case, it's not very scary, right? So let's get to what triple witching is here. It's the expiration of different types of contracts here. So triple witching, which we have today, you see the expiration of stock options contracts, stock index futures contracts, and stock index options contracts. We used to have quadruple witching, which was also stock options futures contracts, but those don't really trade in the U.S. anymore. Now, this happens on the third Friday of every month, where you just get the stock options expiry, and then we get the triple on a quarterly basis on the third Friday of the month. So that is what is happening today. And according to various estimates, we could get anywhere from $4.8 to $5.5 trillion worth of these types of contracts that are expiring today. So let's dig a little bit more into it by looking at a real world example of one of these contracts. Nvidia, the second most active within this universe of these options contracts here. And so there's a lot of open interest, that is open contracts here on Nvidia. This is just one that we picked that's expiring today. This is the $140 call option. A lot of open interest, more than 145,000 contracts here. You could buy this, the last time we checked, for 2 cents. So for 2 cents, you have the right to then take possession of 100 of these Nvidia shares at $140. However, if by the last tick of the day today, the stock is not at $140, and at last check it wasn't. In fact, yesterday we saw it reach $140 and then back off from that level, then this expires and you get nothing. It's worthless. However, if by some chance the stock rose to $140 today, you could sell this contract potentially at a profit, or you would take delivery of those. All of this is a complicated way of saying that when people are making these various option buys and trades, that it creates a lot of offsetting moves in the market. Either you take delivery of these shares, and that creates an uptick in volume in the market, or maybe you're doing an offsetting trade over there, which also creates more volume in the market. So all of this is to say, you see a big uptick in volume on a day like this, not necessarily volatility, maybe a little bit of volatility at the margins in an individual stock, but overall a big uptick in volume overall on the market today between these index options and futures and then the individual stock options. So, Brad, what is the bottom line for you, the individual investor today? If you're not in the options market, probably not much. And if you're not a professional investor, probably not much. So that's something to keep in mind. You might hear a lot of discussion about witching, the effect it has here. But for most sort of long investors, most everyday investors who have your money in your 401k and you're not doing a lot of individual day trading, there's not necessarily going to be a big impact for you.
All right, no sorcery, just portfolio and options strategy here. Thanks so much, Julie, appreciate it. Everyone, let's stay on the markets for a hot second. Stocks are close to the flat line. They're close there. Here on the day, you're seeing some light moves. The S&P 500 has pulled back after topping 5,500 in intraday trading Thursday. And Nvidia is falling for a second day, off about 2% after losing $118 billion in value on Thursday. Wall Street also watching out for the triple witching, which our own Julie Hyman just broke down. Here to help us navigate the market, we have Katie Kaminsky, Alpha Simplex Chief Research Strategist and Portfolio Manager. Katie, it's great to see you and great to dive into some of this week's themes. I mean, we laid out a lot of them, but first, perhaps let's just begin on this equity market march that we've seen over the course of the month of June and whether that's set to continue here.
Yes, I mean, it's been a very interesting month because even though stock markets are up this month, you've seen very different views in the other asset classes. So you saw a lot of sell-offs in some of the risk assets like commodities, and you also saw bond yields falling a lot this month. So the one thing that has sort of held its ground is the equity markets. And I think in some sense, there's a little bit of nervousness about valuations, where we are, and sort of some of the recent economic data. So it is quite impressive where we are given some of the data that we've seen this month.
And so that considered, it seems like the market is really, and as you were kind of putting the inflationary picture up against the market performance, it seems like this is a market that is really going to continue to look for any areas of disinflation ahead of deflation.
Exactly. And what's been interesting and a little bit nerve-wracking to me this month is that the first part of this year, we've consistently seen positive stock bond correlation. We've also seen the market looking for disinflation, looking for positive news in economic data that is weak, but not too weak. This month, on the other hand, we started to see a couple of instances of risk-off behavior where we started to see investors getting a little nervous about some of the weaker economic data. So you saw more of a risk-off type of pattern where investors have started to move into long bond positions. So you've seen yields going down this month. And this is a little bit of a deviation from what we saw earlier this year. So it is a little bit of a sense that the market is pricing in a harder landing probability that's higher than it was before. So I think there are definitely nerves about just the extension and the bifurcation in the equity markets, despite the fact that we are sort of on the right trajectory towards rate cuts and disinflation.
How is this showing up in the bond market?
Yes, good question. We've seen a massive pivot in signals on the technical side for fixed income. You're seeing short signals in fixed income starting to tilt towards long, and you've seen a massive move in yields this month, which is indicative of the market sort of pivoting in some sense towards a more of a risk-off feature. So less focus on inflation, maybe a little bit focus on nerves about the potential for some downside. Considering how far we've gone and how few really negative days we've had this year in equities, it's not surprising that some negative data is making people a little bit nervous.
And so with all this in mind, I mean, the Fed is going to continue to look towards future CPI prints. I mean, it's interesting, especially coming off of the movements that we've seen recently and where inflation still is and isn't. I mean, it's still showing up in some of the services. I mean, shelter, that component continues to really kind of just push CPI in every reading that we've gotten to this point. But how is this all impacting in terms of the inflationary picture, impacting the dollar as well?
This is a very good question. The dollar has been very mixed this month, but there's a couple of things that are holding the dollar up. So one is the fact that, you're kind of seeing the Fed being a little more cautious. You're also seeing that, if you think about trading the dollar versus another currency, what's your alternative? If you look at the alternatives, a lot of other central banks have already started cutting rates. This puts the dollar in a more favorable position. But despite that, you're also seeing little bit weaker data on the dollar, which would make it weaker. So net over net, the dollar is still looking relatively strong this month, despite some of the weaker economic data. I think it's because people need an alternative. You have to think, if you're going to trade against the dollar, you got to pick another currency. And other currencies have struggled some, and they're also much earlier in their hiking cycle, which puts them at a disadvantage over the dollar in carry terms. And that suggests that the dollar is still relatively stable.
Okay, and so here on this witching day, I want to leave investors with some tips here, Katie, as they're really evaluating all the different elements of the trade that come together that we were just discussing here in this conversation. What are some actionable tips that investors can deploy considering the macro backdrop and considering the run-up that we've seen also in equities?
I think it's important for people to be cautious and not too myopic in this situation, particularly in fixed income. So when you're thinking about how should you position yourself, you probably want to think about locking in some yield, but also being aware that you might need some other tools in your toolkit, whether it's long short strategies that have exposure to commodities or other things that might be more amenable to an inflationary environment. So like you pointed out, inflation is not down to 2 yet, which means there's still going to be a lot of movement in other asset classes. And you're also going to see stock bond correlation continue to be positive, which suggests that you need to think about trying to find other asset classes and areas of diversification so that you're not too overexposed to stocks and bonds when they tend to be positively correlated.
Katie Kaminsky, Alpha Simplex Chief Research Strategist and Portfolio Manager. Thanks so much for taking the time here with us. Appreciate it.
Thank you.
Thanks. Coming up, the state of small businesses. We'll speak with Intuit's CFO on how the company is giving small businesses tools to succeed. That is next. Stay tuned. There's been a resurgence in the entrepreneurial spirit with more individuals and small groups venturing into small businesses. Since the start of the Biden-Harris administration, there have been 18.1 million new business applications with an average 443,000 filed each month, a rate 90% faster than pre-pandemic averages. But for small business owners, navigating through sticky inflation and higher rates is no easy task. That's why companies like Intuit, of course, are continuing to keep some of these entrepreneurs top of mind. Joining me now, we've got Sandeep Aujla, who is the Intuit Chief Financial Officer, here with us. Sandeep, great to have you here on the program with us today. First and foremost, I mean, we got to talk about the state of small businesses. What are you seeing from the Intuit seat at the table within this broader ecosystem of small businesses?
Well, Brad, thank you for having me. Happy Friday.
Happy Friday.
You know, at Intuit, we serve 100 million customers, and 10 million of those customers are small and mid-sized businesses. And for us, what we are seeing across the small business platform is that small businesses are actually in a pretty good shape. Their revenues over the last 3 months are up about 3%. When you look at year over year, their profits are up about 2% year over year. And a key leading indicator is how many hours their employees are working. And we're seeing that up about 4% year over year. Now, all those are great indicators, but the small businesses are also looking at their cash reserves. Their cash reserves are down about 8% when you look at the same period last year, but up 16% over the pre-COVID timeframe. So I would say small businesses are in a pretty good shape. And the other thing I would point out that those on our platform and those who have been on our platform for 4 years or more tend to have 60% higher cash reserves than those who are on a platform for less than a year, further indicating our focus on small businesses and really helping drive their prosperity.
Are there common tax code breaks or advantages that small businesses are increasingly looking for in order to make sure that they can securitize some of those profits that they're seeing from their business, or just make sure that financially they're making sound decisions that can help benefit their position or at least put some of that capital back to work?
You know, Brad, the number, so on the tax side, we do small business taxes, and we always make sure that they are getting access to each and every benefit that's available to them through the tax code. But what I would highlight is that the number one need of a small business, the area they're focused on the most, is helping me get and grow customers. And that's where we are really excited about what we're bringing to market through our innovations such as revenue intelligence, by combining the billions of data points on on QuickBooks as well as on MailChimp. So that's where our focus is in helping them grow their businesses, helping them improve their cash flows, helping them save time, while we also make sure that they're compliant with the tax code and getting access to each and every benefit that they're entitled to.
Certainly here. You know, it's interesting. As you were mentioning the employee hours that are being worked for some of these small businesses, I wonder how you're seeing small businesses navigate this labor market right now.
The labor market, you know, we can reflect on where it was a couple of years ago, and companies of our scale were having challenges recruiting and retaining employees. So you can imagine the challenges that the small businesses were having. The market has very much normalized, and we are seeing small businesses continue to have a better time adding employees. They're having more success retaining their employees. And the pressure they felt on their cost structure by having to give those pay increases has returned to much more reasonable and normalized levels. So it's a order of magnitude better environment that they're navigating now than where they were, say, circa 2 years ago.
Certainly. You know, when we hear about the developments in artificial intelligence and where that may eventually trickle through to small businesses as well, what types of advantages do you see small businesses being able to reap from artificial intelligence, and when that may happen in full force or critical mass?
Such a key point and important question. For us, let me start out by sharing that we've been focused on AI years before it became fashionable to talk about AI. And we were talking about AI back in 2018 when we declared our strategy to be an AI-driven expert platform. And for us, it is really using the benefit of billions of data points we have across our ecosystem to help drive prosperity for each and every small business and consumer on our platform. So when you think about AI for small businesses, there's really two key areas we're focused on: helping them save time because they'd rather run their business than do their accounting or manage their cash flows. And two, helping them improve their cash flows, because that's the number one indicator of success or failure for small businesses. So when we look at the experiences we're delivering through Intuit Assist, which is our Gen AI engine that's helping drive the experiences for small businesses, we are looking at turning photos of receipts into entries into QuickBooks. We are taking vendor PDFs and turning those into bills that small businesses can then pay electronically. We're taking the email threads and the handwritten notes and translating them into electronic estimates or invoices that they can send pay-enabled and get paid a lot faster on our platform. And finally, we are helping bring revenue intelligence through our MailChimp platform and our QuickBooks by using billions of data points to help small businesses segment their customers better, by helping small businesses target their customers at the right time to maximize their revenue potential, by quite frankly, providing to small businesses insights and customer funnels that were historically reserved for very large enterprises such as ourselves. So that's where we're really leaning into our capabilities and AI to help drive small business success. And as you know, and you pointed out earlier as you introduced me, that small businesses really are the key contributors to our GDP and a leading indicator of the success of the nation as well as our economy.
Absolutely agree. Sandeep, I would be remiss if I didn't ask you just a quick question on the business here. I mean, of course, you know, here at Yahoo Finance, we track the stock performance, Intuit underperforming some of the major averages this year. It's still up by about 3.5%, the share price is, over the course of the year to date. I wonder, as you kind of look at the business on a go-forward basis, after this major FTC ruling and investigation finding TurboTax free is not free for most, and Intuit not renewing the free file program, what that does for some of the guidance that the street is really trying to wrap its mind around at this juncture.
Sure. A couple of things I would say. One is we have always offered free products. In fact, we were one of the early innovators in the free space, and free is a key component of the tax industry. You have many free participants in there, and the government introducing a free offering is not a material impact to the industry, and quite frankly, I think it's not a good use of our fiscal spending either. And in terms of our guidance, you know, what we are really excited about on the tax business is it's a $35 billion market. And 30 billion of that market is helping small businesses and consumers get their taxes done. And these are the folks who typically go to someone else to get their taxes done. This is where we are excited to use our AI, to use our live expert platform to really helping small businesses and consumers getting their taxes done. And that's the part of the business that we're really highlighting to the investment community. It's a business that grew 17% last year. It is $1.4 billion in revenue, representing about 30% of our overall tax revenues. And it is a business that we continue to invest in and are quite excited about its growth prospects. And that's what's bolstering our confidence, quite frankly, on our ability to continue to scale our consumer group and our tax revenues.
Sandeep, I appreciate you taking the time to address that with us, plus looking across the small business landscape as well. Very important topic in conversation. Sandeep Aujla, who is the Intuit CFO. Appreciate the time.
Thank you, Brad. Appreciate it.
Certainly. Well, everyone, it's never been fun to think about the reasons why you might need a life insurance policy, but that doesn't mean it's something that should be avoided. For more, let's welcome in Ross Mack, who is the Yahoo Finance contributor, joining us here to talk all things life insurance today. Where do people need to start when they're going through the mental process of this?
Yeah, it's obviously a huge burden to think about, you know, we're going to pass away, right? The one thing that's actually definite in this lifetime is that we're all going to pass away at some time, and the worst thing we could do is leave our dependents, to leave our loved ones both grieving as well as financially burdened. And for that very reason, we need life insurance. And you got to understand what it is. It is supposed to actually replace your income. And so you got to understand, like, when it's all said and done, it costs about $8,000 just to pass away, right? Like it costs. Your final cost, you know, in order for your body to go to the coroner, to have a funeral, et cetera, it's roughly like the median cost is roughly $8,000. And so when you're thinking about life insurance, it's a few things you want to say, okay. One, I want to leave my dependents with some money that is going to replace my income. And so, you know, why do I need to do that? Well, one, that might actually help them pay off the remaining balance on my mortgage. That's also going to hopefully give them some type of financial footing that doesn't allow them to, like I say, continue to be grieving, but also be financially burdened and having other stresses in their life.
Certainly. And so as we're taking a look at some of these reasons here on the screen, if we can just toss that back up real quick, because you were just running through some of these, it also hits on the wealth transfer and estate planning. Let's just touch on that once again here real quick.
Yeah, so when it's all said and done, right, like when it comes to estate planning, one component of it is to have life insurance, right? And you have to understand, if you were to die without a will, unfortunately, your money's all of your assets are gonna go to probate. And from there, that could potentially be costly. So when we're talking estate planning, life insurance is a big component, and that now allows, your wealth to actually transfer based on all of your wishes, right? Say you got 3 kids, you get, a niece, a mom, you have the ability to divvy that up based on what you actually want. And then when it comes to saying exactly how much you need, I always find that to be a big one, right? Because the average person feels as though, oh, I work, I have life insurance at my job.
Right, through your employer.
That should be enough, right? That should be sufficient. Well, the reality is that's actually not enough, right? The average job, it's called group life insurance. You're gonna get roughly 1 to 2 times your salary.
Mm-hmm.
So if you think about that, right? If you were to pass away and you get a lump sum, say you make $100,000, well, guess what? Your family is only used to having that $100,000 for 1 year.
Mm-hmm.
The idea is that you want to have roughly 10 to 12 times your annual salary. So when you're thinking about exactly how much life insurance you need, understand that what you get from your employer is not enough. You need to say, okay, if I make $100,000, I need to have a life insurance policy at a minimum of $1 million up to maybe $1.2 million. And the idea there is this, right? You get that death benefit. Now your family has the ability to take that and invest that. Now, if you're investing, call it $1 million, you maybe call it a safe 7%,
sure,
tax-free or after taxes or something. Now your family's able to actually replace your income. And then you could actually reconfigure that thinking, okay, say I have 2, 3 kids and they're young of age or not of age, well, maybe another expense to think about is sending them to college. So you might actually want to have more. But if there's one thing a person's looking at this right now, understand that what you get at your job is not enough. And so one of the things you want to think about is, okay, what other, life insurance could I get to actually supplement that?
That's a great reminder, and a reminder that I need to go complete my physical for my life insurance policy here. So I appreciate that. Thanks so much. Ross Mack, Yahoo Finance contributor. Everyone, we've got much more wealth on Yahoo Finance after the break. Fresh housing data out today shows the median existing home sales price reached its highest level ever in May. That's according to the National Association of Realtors. The combination of high prices, high mortgage rates, and low inventory have been weighing on potential home buyers for a while. And a new report from Harvard University's Joint Center for Housing Studies shows both home owners and renters are increasingly cost burdened. Here with more is Alex Herman, who is the Senior Research Associate for the Harvard Joint Center for Housing Studies. Great to have you here with us, Alex. First and foremost, you see a print like we got today's. What does that signal for homeowners and renters?
Yeah, so this just is compounding the affordability challenges we've experienced the last few years, right? With home prices annually hovering at around 6%, it only adds to the more than 40%, nearly 50% home price growth we've experienced since the start of the pandemic, basically, since early 2020. On top of that, you have these high interest rates this year hovering around 7%. And that's really made a fundamentally unaffordable housing market for many potential home buyers. So even for households who can afford a home, right, limited inventories mean the options that are available for you are few and far between. So the median sales price is about 5 times the median household income, and that's pretty close to record highs we experienced a year ago, and up from 4 in 2019 alone, and averages of 3 kind of historically over the last 20, 30 years.
Yeah, I'm taking a look at that 30-year, and I mean, we've now got a 4-week average of sub 7. I mean, of course, it's still, a hair's breadth away from 7, but all that considered, one of the huge things is potential home buyers who are trying to get into this market, but trying to figure out how to plot their entry point. What is the recommendation for them?
Yeah, I mean, so for many of these home buyers, right, this is an impossible market, right, for all but the highest income, most affluent. Many households are having to sit out. So the typical cost for the median price home is now at an all-time high, hovering around $3,000 if you make certain assumptions around a 3.5% down payment. The income needed to afford that payment on a median price home has up from about $82,000 annually in 2021 to $120,000 this year. So that's a $40,000 increase in just 3 years, and that's priced out many potential home buyers.
Certainly. You guys have some fresh data out as well, and within your report, you really discuss the different, and you were starting to go into it there with some of how the affluent portions of and groups out there are doing compared and faring compared to those who are earning less than $30,000 annually, or those who are in middle income but still having to pick and choose if this is the time or where the markets are that they feel comfortable at least submitting a bid for. Break down some of that data for us that you're seeing.
Yeah, absolutely. You mentioned the cost burden data that we talked about. We talked about in our report that we released just yesterday. So cost burdens have increased significantly for homeowners. Cost burdens, a cost burden homeowner, a cost burden household means they spent more than 30% of their income on housing costs and utilities. So about 20 million homeowners were cost burdened at last count in 2022, and that's an increase of 3 million. And you've seen especially large increases among lower income households. So overall, about a quarter of homeowners across the country were cost burdened, about 23% of them in total. And driving that increase in large part are just increases in housing costs. So even for homeowners who have an existing relatively modest payment, mortgage payment due to their lower interest rate, you've seen pretty substantial increases in property taxes and insurance costs. And that's driving kind of this increase in cost burdens. And that's especially challenging, right, for lower income homeowners and older adults in particular on a fixed income who can't quite absorb those cost increases in the same way.
Absolutely. Excellent research there. Alex Herman, who is the Senior Research Associate for the Harvard Joint Center for Housing Studies. Alex, thanks so much for taking the time here with us today.
Thank you, Brad.
Certainly. Some large U.S. cities, among the most popular during the pandemic, are seeing a rebalancing in the housing market. Here with some of the details on this and the full story, we've got Yahoo Finance's Rebecca Chen. All right, so what cities are we talking about here, Rebecca?
Hey, Brad. Yeah, so we saw some data that a lot of or a handful of U.S. cities are seeing a price decline, and these markets are mostly located in Texas and Florida. And what's more is that a handful of them were known as the pandemic boom towns. The city with the largest decline in May included San Antonio, Tampa, and Austin. Now, if we backtrack and look at what happened during the pandemic or just a couple years ago, these were some of the most popular cities that Americans were moving to. They were also the cities that saw home prices surge during those years. For example, in Austin, home prices over 2 years increased almost 70%. And now we are definitely seeing a reversal or a tide change in that. We chatted with a couple experts on why the markets are seeing a decline, and there's really a couple reasons. The most and foremost is that there are a lot more inventory. So from the builder side, builders are ramping up developments in these markets. In fact, Texas and Florida has some of the highest number of housing permit authorized than anywhere else in the nation so far in 2024. Home sellers in these cities are also listing more homes on the market. And the reason for that is really quite interesting. And it's because there is a rising premium cost in house insurance. As we can see, because of the geographical location of Texas and Florida, they're really more subject to a lot of the natural disasters like flooding and hurricane. In Florida, as you can see on this chart, the average premium is about $11,000. Texas is about $4,500, while the national average is about $2,400. So that's a big difference there, and that is pushing a lot of home sellers to list their house on the market that we're seeing today. And the last thing is really from the demand side. We're seeing a lot less Americans moving to these cities. One of the local agents I spoke with said that the allure of the city is the lower housing costs. That's why a lot of people moved there during the pandemics. But as housing costs increase, the affordability factor really is just not there anymore, or not as much as before. And that is causing a lot less demands in these cities. So a combination of all these reasonings is sort of balancing a market that was hyperinflated during the pandemic. But experts are saying that this is not a crash in these markets, but more of a correction back to what is normal.
All right, the area code corrections taking place. Thanks so much, Rebecca, for breaking those down for us. Appreciate it. Well, as Tropical Storm Alberto makes landfall off the Gulf of Mexico, the National Oceanic and Atmospheric Administration is reporting catastrophe losses topping $25 billion so far this year during 2024 due to extreme weather events. And with NOAA predicting a record number of hurricanes this season, now could be a good time to make sure you have everything in place to protect you from heavy financial burdens due to weather. For more, let's bring in Rulon Washington, who is the Wells Fargo Mortgage Sustainability Leader. Rulon, great to have you here on the show with us today. I mean, I think it was pretty astounding, even as we were thinking about the number of billion-dollar weather events that NOAA has already seen and marked over the course of this year, when I think the historical average is something like 8.5. We've already seen, I believe, 11 just by the beginning of June. So what does this set up for catastrophe losses and insurance and making sure that individuals and homes are protected?
Well, there are a few things that you must keep in mind as you're going through a storm. I'm based in Florida, so I deal with hurricanes every year. It is a chore for me and my family. Over the last 18 years or so, it's always a mad scramble. So, a few tips I would provide to families out there is make a checklist. One of the biggest tips to prepare for a natural disaster is to create your checklist. Think about all the essential steps and items that you need to have accounted for during a storm. I mean, it's important if you plan to stay and ride the storm out. I mean, I am guilty of that a few times of trying to ride out a storm. But, ultimately, if you're planning to evacuate, you need to make sure that you have a checklist. I would also encourage folks to gather important documents. Make sure those critical items such as your birth certificates, passports, mortgage and insurance documents, and all of those possessions that you keep in a secure place, make sure that you know where they are, right? It's hard to replace the originals, right? So those documents that are extremely important and difficult to replace, make sure they're in a safe place. This is especially important for those families that live in areas where there may be wildfires, tornadoes, and also hurricanes, right? Because unexpected disasters don't give you much time to plan. You also want to make sure you're stockpiling savings, make sure you're reviewing your insurance, that's critical, and make sure you're protecting your credit. I mean, that's one of the most essential pieces after the disaster. Making contact with your creditors early will help you get a better understanding of what assistance may be available for you if you're impacted. I mean, the goal is to find solutions to avoid any negative impacts on your credit report, right? So protecting your finances involves protecting your credit. Ultimately, if there is a disaster, there is that obligation that still needs to be made. So if there's a scenario where you need to evacuate, reach out to your creditors as soon as possible, request a possible suspension for your payments, or just to make sure that creditors know that you need to be accommodated for your circumstances.
Certainly. With that in mind, what payments do you still have to make, even in the meantime, while you're submitting a claim, if your property is damaged or, in the worst case scenario, destroyed?
Yeah, unfortunately, with your mortgage payment, you're still obligated to make that mortgage, but work with your mortgage servicer to understand your options. Making immediate contact will allow the mortgage company to start tracking your specific situation and to put initial protections in place to prepare you for insurance payout or for federal aid. So that's waiving late fees or help you worry about any impacts on your credit. So families that have experienced extreme damage in specific areas, you can work with your mortgage servicer, but there's also that FEMA or disaster assistance that's out there too. So just make sure that you understand that obligation still needs to be paid, but make sure you're working with those entities that are at play. Also contact your insurance company. You want to make sure you're reaching out to your homeowner's insurance company immediately to start that claims process if you do have damage to your home. Every insurance policy is unique, so it's important that you understand the protections that you have before that disaster hits.
What about an emergency fund that people need to have set up? I mean, we often hear this number tossed around of people not having $400 for an emergency, but it seems like that number has moved higher and should move higher. And for an instance like this, it should perhaps be a little bit more encompassing. What is the real figure that people should have earmarked for this?
Yeah, so stockpiling savings, I mentioned that earlier. So an emergency fund is usually 3 to 6 months worth of savings. It's a key part of that any financial household plan. I mean, if you're asking me, it's hard sometimes to save up 6 months worth of expenses, but that's sort of the rule of thumb. But when a disaster strikes, only 18% of folks are ready when it comes down to have financial stability in that transition, right? So consider setting aside some cash to see if you can get through those areas that may have lost power, or they may have access to banks or ATMs are out of commission. It's usually a power outage during and after a storm that really impacts you the most, right? So having a few $100 on hand can go a long way. And usually that rule of thumb of 3 to 6 months of savings, I mean, it's critical, right? If you have cash on hand, especially when there's power outages during the storm, it's really advantageous. Having just savings on hand is really important when you're going through any duress, but ultimately think about what happens after the storm.
Rulon Washington, who is the Wells Fargo Mortgage Sustainability Leader. Rulon, thanks so much for taking the time here today. Some very important tips for people to hopefully put some action around ahead of some of these severe weather events. Appreciate it. Thanks. Everyone, we've got much more on wealth after the break. You're watching Yahoo Finance. Wealth and asset management institutions are at the forefront of adopting innovative technologies like Gen AI tools. 9 out of 10 managers are currently using or planning to use AI in their investment processes, according to consulting firm Mercer. So the question no longer remains if, but how are managers implementing AI capabilities into their everyday investment strategies? And at least that's what our next guest says. Here to weigh in, we've got Raylan Lambert, who is the Mercer Global Alternatives Leader. Great to have you here in studio with us.
Pleasure to be here, Brad. Thank you.
Let's talk about this. I mean, how much of a role can AI really play in some of those investment decisions and the broader world of finance, if you will?
Well, it really depends on where managers are incorporating them into their process. You know, 5-10 years ago, the focus was on data science and how can we mine the information we have to provide better maybe intelligence and reporting. But today, AI has taken everything to a whole new level. So you're seeing managers deploying it with respect to sourcing and screening new investment opportunities. You know, they might have specific criteria that they're looking for, say in the middle market, certain segments of the economy. Where they're using it in that regard. But compellingly, they're also using it as they look across their portfolio and understanding the data that they collectively have and ownership. How can they then connect the dots of that data and maybe even bring to market new products and solutions on behalf of clients?
I mean, is this something that the client would engage directly with, or something that managers would use and leverage as a tool to say, okay, this is the investment decisions that we've made in the past, this is the mix of your portfolio or the risk propensity that you can add on, or where you should perhaps mitigate some of the risk that you currently have in your portfolio right now? Like, where is this touch point happening?
The touch point is happening on two places, at least in the most simplest form, right? One is how the manager is integrating AI into their own investment decision making, into the data, as I mentioned, that they're sitting on, how they're utilizing that to bring forth maybe new ideas across the portfolio. The second big place so that managers are using it is as limited partners, you know, as investors in those managers' funds, we like a lot of data and we like it, you know, immediately. So managers too are finding ways to integrate that technology into their data rooms, into how they're reporting information to their investors. And that's cutting down on the amount of time so they can provide more value-add analytics on other, you know, aspects of portfolio consideration. So it's both within their own portfolios, but also in their reporting and monitoring and updates to investors.
Okay, so what are the early returns that we've seen that are showing a difference between, okay, this is your portfolio without this layer of artificial intelligence, and here's your portfolio performance with this layer added in?
I would say that we haven't seen it broken out that way yet. I think, you know, when you briefed, you mentioned at the outset, you know, the 90% stat that we found with our AI study. And, you know, while it's 90% overall, roughly 40% of managers are still contemplating incorporating it into their processes. So I think the real, you know, where we'll probably start seeing it show up is as companies, you know, we know distributions have been down, and so the big focus really now is on EBITDA enhancement. How can these managers add value to the EBITDA of the companies? Because the longer, if you were to sell that company at the same valuation 1 year later, your rate of return is already down by 300 basis points. So the focus is on EBITDA. So that's where I think, as we look at, you know, what value creation levers the managers have to add value to their portfolios, we might see at one point AI as one of those levers. Mm-hmm. How are they utilizing it to enhance productivity, to enhance, you know, streamline processes, to cut down on other costs of the business? And so in that regard, you know, we'll see, but we haven't seen that show up yet in terms of actual measurability. I think it's still early days.
Just as long as AI does not shame me about my trades that I'm making, that would just hurt, add insult to injury on the portfolio performance basis. Thanks so much for taking the time.
Yeah, I appreciate it, Brad. Thank you.
Raylan Lambert, who is the Mercer Global Alternatives Leader. Coming up, everyone, we've got much more on wealth after the break. You're watching Yahoo Finance. High net worth individuals globally are reaching unprecedented numbers and wealth levels. Wealth expanding by 4.7% in 2023 as the population of high net worth individuals rises 5.1%. To shed light on what moves the ultra wealthy are making with their money, we have Elias Ghanem, who is the global head of Capgemini Research Institute for Financial Services. I mean, this is particularly interesting because one of the interesting kind of markers that I've heard, at least, and many out there who are paying attention, is the number of millionaires that are being minted on a daily basis here, whether in major cities like New York or elsewhere. So how is that playing into the investment strategy and the returns for some of the ultra high net worth individuals out there?
In fact, all started last year when we looked at the numbers last year. Everybody went in wealth preservations, right? Things were very confusing last year. So we saw all the numbers in total wealth and in population of wealth going down. And we saw the asset classes where you put your money, depending on how you are. Last year, you throw all your money in cash. So you know what? Let's wait and see what's happening. What are we observing this year is cash equivalent is down back to 25%. Fixed deposits is building up, real estate is building up, and alternative investment is building up. People are slowly but surely moving from wealth preservation, let's be safe, to wealth growth.
And so that sounds like taking on a little bit more appetite for risk, potentially. Where are some of the riskier elements of the portfolio that you're seeing being tapped into right now?
It's starting. Let's be realistic, right? It's early days. People are start looking. Such a geopolitical environment, so complex, half of the global population going on election this year, all that, and then all the wars that are happening left and right, unfortunately, all that makes people quite a little bit careful. But on the other side, tech stock market is doing very well. So there are bets, people are making bets, and we've been observing that in our wealth report, that people are starting to say, we're starting to do some bets and investing in some opportunities.
There were some of these individuals or households that were able to invest at times when other people needed to pull money out of the market. And I think back to the COVID pandemic when we saw a massive dip, of course, the bottoming out in late March of 2020, and ultimately a heavy buying back in action when it felt like, okay, at this level, we need to put some of this cash back to work. That's an opportunity that not a lot of other people had, but where did some of the wealthier individuals and households buy into at that time that helped solidify wealth and returns even further?
Three categories: real estate, alternative investments in terms of private equity, and some investment into bitcoins and cryptocurrencies at different scales. Real estate, we had high interest rate, so logically people start buying houses, so the market went down. If you have the cash, that's the right time to do it. Logically, private equity, ultra high net worth individuals have a long-term view and are able to make bets on a much longer term. And by the way, we are in such a transformation of the economy from to renewable economy that there are bets to be made. And cryptocurrency, depending on how the Bitcoin goes up and down, people are interested. We're observing that quite a lot recently.
Capgemini Research Institute's Elias Ghanem, thanks so much for taking the time here with us today.
Thank you so much for having me here.
Absolutely. That's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. You could stay tuned for Market Domination with Julie Hyman and Jared Blickery. That's coming up at 3 p.m. Eastern Time. You do not want to miss that. They'll count you down to the closing bell.